So, welcome to the Tax Talk podcast and the second episode of an exciting two-part mini-series with Justin Lamb. Justin is a chartered professional accountant, chartered business valuator, and a founding partner with Jones Lamb LLP. Since 2014, Justin has been working in the field of financial litigation and business valuation. In early 2022, Justin and his business partner, Mark Jones, started up Jones Lamb LLP in Edmonton, Alberta. Jones Lamb LLP was founded with the vision of creating value through innovation. They strive to provide value by blending subject matter expertise with their data science and toolkits, their creativity, and by striving to make the complex appear simple. Justin, thank you again for taking time out of your schedule to hop on the podcast with me.
Hey, no problem. I appreciate being here.
Right on. So I definitely enjoyed our first discussion, kind of a holistic view of, when a client might need evaluation, what they're good for, maybe when to reach out to that chartered business valuator. So kind of more of the broad-based topics there, looking at how CRA impacts evaluations and things of that nature. So getting into this second episode, want to maybe get into some of the more detailed aspects of the valuation, maybe what a client can do to make their business more valuable when it's getting, to that time that they're looking to sell. And then kind of just looking at some of the intricate details that go into how you might come up with that valuation. I know from doing some simplistic side stuff at the accounting firm here, making some adjustments for differing expenses that might be applicable to one owner but not another owner down the road. So looking at some of those aspects, I think that'll be helpful in business owners maybe making some adjustments to their operations to get their business in the best possible place to sell down the road. So let's jump into it.
Okay, sounds good.
Right on. So question number one, how can I adjust my business so it is run in a way that is a little bit more consistent with maybe how an arm's length party would run it? And I guess what we're kind of looking at here is, sometimes I know clients at the firm here, there might be a bit of a blurred line sometimes as to, what is business, what's personal. Is there ways that you kind of advise clients to maybe clean up their operations to get them in a better spot for you to be able to provide those valuation services?
Yeah, no, that's a really good question. And it's kind of like the question implies, to run more like an arm's length party, just really think about, if you were to buy a business from somebody, or if you had, an unrelated shareholders, if there's a group of shareholders, there's a lot of things you wouldn't do. You're not going to suddenly expense that trip to Vegas that might have a very small business component, but otherwise, is generally for personal, or you're not going to, pay yourself double maybe what you would pay an arm's length person for that role. And we're not saying, it's your business. We're not saying, you can't take cash when you need to or whatnot. It's just, it's really just the optics around making it look like it's managed the way, a group of unrelated people would manage the business. So if you paid yourself a wage that's representative of, if you had to go to the market and hire somebody to replace you, what would you pay them? If you, really made a strong emphasis or tried not to include expenses that are discretionary, you're not including, like I said, trips that probably aren't business related. You're not expensing, a lot of meals and entertainment that really aren't, required for the business. And you're not purchasing, a ski boat in your company. And on the basis that, you use it to entertain a few clients and therefore, you can justify the business use. That's an extreme example, but all those things, when it comes time to sell, when you're showing a potential purchaser, this is how much cash flow this business generates. And to get to that number, you have to make 10, 15, 20 adjustments, it raises a lot of uncertainty, and it kind of puts puts a bunch of red flags up, and now they start wondering, is this business as good as you say it is? You have to do all this stuff to arrive at the number that makes it worth what you're asking. Whereas, especially if you're thinking of selling in the next 5, 10 years, by managing it in a very transparent and arm's length way, it really makes it a lot more saleable. If somebody's going to buy it and they see, hey, that income statement is very clean, there's no discretionary items there. It's straight up business expenses. Assets, there's no kind of redundant assets, which we'll talk about later. It's just everything, wages are all at fair market value. You're not employing, 3 or 4 kids that aren't really working for the business, but all receive a wage. Just those things alone just make it more saleable. It makes it easier for somebody to step into your shoes and take over that business.
Right on. Yeah, I think that's a good point. I mean, beyond even just considering, certain expenses that CRA might even put in that gray zone, like you said, I think a lot of times these discussions, they initially start off maybe one party looking at another party's financial statements. But if you have to go from point A all the way to Z and make all of these adjustments for all these things, I don't think it really gives that purchaser a whole lot of faith in, the underlying numbers that you have there. And I mean, if you've got to make, like you said, a whole pile of adjustments to get there, is there something else that maybe you're not fully disclosing? Is this really just more of a way for you to kind of pad your personal lifestyle? And I think, like you say, if you clean out some of these things, you know, you might have the odd adjustment, whatever the case might be, maybe some owner's wages that are maybe slightly out of the norm. But, if you make those simple little adjustments, I think that puts a lot more faith in the purchaser and probably speeds up the negotiations in that process.
No, and that's exactly it. And just on a related vein, if there aren't so many, especially if you're looking at selling the shares of your company, because maybe you want to take advantage of the capital gains exemption. If a purchaser sees a lot of discretionary items, or like you said, gray items that CRA kind of toes the line, suddenly they might not be interested in buying the shares. They're more going to look at buying the assets because they don't know in 5 years if CRA audits a year. They don't want to take on that liability of something that you did, but now they have to deal with. And so it could also eliminate that opportunity to vend your shares and take advantage of those that capital gains exemption.
Right. Yeah, and depending how that plays out, if you're in the market to sell your shares, and then based on, having to make all these adjustments, you're forced into kind of getting rid of the assets, that might be a significant tax bill that you were otherwise not expecting to have. Could impact the retirement plans or some sort of, plans to move to the next business or something like that. So yeah, it's good to kind of keep things clean on the level and be transparent to ensure you're not throwing yourself a wrench down the road, for sure.
No, exactly. Because at the end of the day, a lot of people don't realize it until they go to sell their small business, but it can be very challenging to actually sell a small business. And if you can make it as attractive as possible by, like we talked about, making it as arm's length, as transparent, it just increases those odds because it's just the nature of a small business. They can be tough to find a buyer and then find a buyer with money.
For sure. Yeah, so it's always good to be prepared, ready to execute that sale. And if you're not doing the things and taking the steps to keep that business in check and all the expenses on the level beforehand, then yeah, you might be missing out on some of those opportunities. And if they don't come around too often, you might be left holding the bag down the road. So better just to be prepared than maybe push the envelope on some of these things. So perfect. I think that one kind of does justice on question 1. So moving into number 2, And you kind of briefly touched on this in number one. What is the difference between a redundant asset and an operational asset?
Yeah, so that's quite common in business valuation. So a redundant asset, it's like the name implies, it's an asset that's not required in the day-to-day operations of the company. So, you can think of the very obvious ones, in extreme cases, like I mentioned, a ski boat.
Right.
And I say it's extreme, but I have seen situations where people have done that, where they own assets such as a ski boat within their company on the basis that, hey, there is that small maybe promotional aspect, but in reality it's not required in the business, and so that would be removed as a redundant asset in our analysis to clean up kind of the balance sheet in terms of what would a buyer actually buy, because at the end of the day they're not going to be interested in buying those assets. And it can also be assets that are less straightforward, such as excess cash.
Sure.
Maybe this company has built up a large cash reserve and it's just holding it in the company. There's nothing wrong with that. It's, you don't want to incur that tax liability by dividending it out to the shareholders. You just leave it there and defer it until needed. And so, in our analysis, that might be something that we might consider redundant, as well as things like investments or even, a shareholder debit balance. Maybe the company owes the shareholder money,
Right.
or there's related party loans, things that, if you want to think about it, if the business is not in the business of doing, like if the business is not in the business of lending people money,
Right.
and therefore that would be considered redundant. And when we're doing an analysis, I think one thing to keep in mind, especially around things like cash, is what are the company's liquidity ratios? How does its current asset ratio look like? What does its debt to equity ratio look like? And how does that compare to the industry? Or does it have existing debt facilities in place that, say, hey, these are our covenants. You can't exceed X for your current ratio or Y for your debt to equity. And if by removing that cash on a notional basis, it breaches those covenants, well, that's an indication that cash is not redundant and it's
Right.
required in the business. So we'll look at things like that as well, to determine, how much, for example, cash is redundant, or how much can potentially be removed without putting that business in a bad spot.
Right. I think that's an interesting point. I don't think I've ever looked at it that way, because I know we get a lot of clients, they get into that, point in time in, the business life cycle that, for a number of years, they've accumulated a bunch of cash. Maybe just looking at the balance sheet in general, you say, well, you got a pile of cash here, but maybe looking into those ratios in more detail gives you a bit more insight as to what is actually the excess or the redundant portion of that cash. Because then I think it's probably twofold. You can, make some decisions as to what to do with the actual excess. And then it probably also helps you in maybe having that discussion, should CRA look at some of these things to say, well, we did some due diligence here and we said, they've got a couple $100,000 here. You might think it's excess, but based on, these working papers and these calculations, they need this money to operate. Otherwise, they're going to be in a cash crunch. So that's a good point, I think, on that side.
No, that's exactly it. And I mean, this might be a bit off topic, but we see that scenario, or similar scenario a lot in terms of, we do a lot of matrimonial work. And so when people have a business, often when it comes to spousal support, one party will be looking at the balance sheet and they'll see a large net income number, and they want all that net income to be attributed for spousal support purposes. And not every time, but sometimes we have to, after we analyze it, we can see, hey, this company A, it can't distribute that net income. It needs to retain it because it has to service its debt.
Right.
If it pulled it out, you'd be offside with your covenants, or it needs to reinvest it for capital assets and whatnot. And so it's just another way that we often see this issue brought up, because people sometimes get lost in terms of what bottom line net income is versus what is actually the reality of a company's cash flow situation.
Right. Yeah, and those two are very different, just because you can net some dollars on the income statement doesn't necessarily mean that the company's healthy overall. You might be really struggling in the cash flow department. So yeah, that's another interesting point, because I think a lot of times, just like looking at that dollar value on the balance sheet, looking at that net income for, splitting out spousal support, that might not tell the whole story. There's a whole lot of cash flow items that are represented up in that balance sheet that need to be accounted for, as opposed to just splitting out those monies for spousal support payments. And then I guess the other thing that you kind of mentioned as far as the redundant assets. So if a client were to maybe contact you, or if you get a referral in and you're looking at those redundant assets, is that then something that you'd kind of work with maybe their accountant to get cleaned up? Not necessarily before the valuation, but maybe in conjunction with, to, like you say, preserve that lifetime capital gains exemption. Is that kind of something you guys work with?
Yeah, no, exactly. It's we definitely like to highlight that, especially if they're not, if they're being a bit proactive and they're not thinking of selling, next year. It might be a few years down the road. Then there is time, to have those discussions with the client and the accountant, so that they can start making the steps, as far as stripping out excess cash or redundant assets, so that, one, the company's as saleable as it can be, and two, they have the best odds of making use of your lifetime capital gains exemption, because it is a huge benefit if you're able to use it, and often you only get one shot to use it. It's not most people never have the opportunity, and if you do have the opportunity, you definitely want to make use of it.
Oh, good point. So moving into number 3, and this is kind of maybe more of an emotional question. Am I overvaluing my operation? I know when I've kind of done a bit of this work with clients, I think there's always this tendency to, put that emotional connection forward. I think whenever you own a business, not incorrectly, but you value it very highly. And I think when it goes time to selling it, and maybe you start seeing some of these numbers, that maybe business owners are taken back a bit by it, because they don't necessarily feel that maybe the years and the hard work are all accumulated and properly accounted for. So is there a way that you kind of maneuver maybe that with clients? Obviously, here's the end value that we've come to. Here's the supporting documents and stuff that led us to get to this point. But is there a way to kind of convey that with a client and kind of help them understand, yeah, this is the dollar value, and we understand that, you've got that attachment to it, and you're going to have to work with us to keep moving this process forward?
Oh, it's it's a really good question. It does come up a lot. It's you don't often see somebody undervalue their company,
Right.
but you definitely see a lot of overvaluing. And it's exactly like you said, if they spent a lot of time, it could be 20, 30 years building this company, there is an emotional attachment. And you obviously don't want to, give it away. But at the same time, if you're serious about selling, you do need to be honest with yourself in terms of the cash flow that business generates. At the end of the day, value is going to be driven by prospective cash flow, and how much cash flow is that business generating. And I think one thing that people sometimes get confused is you don't mistake the the fair market value as your wage as part of cash flow. So you might pay yourself $100,000 a year, but if you had somebody to replace that role, you'd pay them $100,000 a year. So that doesn't mean that you would look at your bottom line net income and add back your wage and try and tell somebody, well, look what it's generating. Because at the end of the day, people, when they buy a business, their goal isn't to buy a job. Their goal is to buy business that's going to generate them excess cash flow, and that's what drives value. So that's always important. We see people make that mistake quite a bit, where they try and factor in their wage as part of the cash flow, but really that wage is it's what you'd have to pay somebody anyways, because you're obviously, you're doing a lot of the day-to-day work. And then, just it's understanding that, sometimes people get confused. They look at, like, for example, the public markets, and they see the multiples that public companies are trading at. And they're like, well, wouldn't my business trade at, an 8 times multiple,
Right.
or a 6 times multiple? This public company that does something similar, obviously on a much larger scale, is 10, 15, 20 times. And it always goes back to, value. One of the key tenets of valuation is value is influenced by liquidity. So the more liquid an asset, the greater the value. And so, that's one of the reasons why public company shares trade much higher than private company shares. Is, you and I can own a share and we can sell it instantly and get our cash. Whereas if we put that same money in a private company, there isn't that liquidity. It could take you a month, 6 months. It could take you multiple years to sell your investment. And so that's one of the reasons why private companies trade a lot less than public companies. And it's something to keep in mind. And really, it is just, value is perspective. It's the value of the prospective cash flow. So just be realistic in terms of what your business is able to generate.
Yeah, no, that's a real good point. That kind of brings me back to that first episode that we recorded, and maybe why then it is important to bring in that chartered business valuator at that junction. If that business owner is maybe discussing these types of things with his longtime accountant, there's probably a good working relationship there, but maybe you're not able as an accountant to maybe, have some of those more frank discussions. And maybe it helps to have that third party come in and say, yeah, you're taking out 100K, but, if you had to replace yourself, it might even take more than that because of just all that inherent knowledge and experience that you have that you simply just can't pass on to one or two maybe employees to fill that hole. So yeah, maybe having that third party evaluator in there to kind of guide that discussion would be a way to kind of navigate those overwatering values.
Exactly. And it also just helps, when you have, a valuation report, in terms of just seeing the mechanics of how the figures are derived and the adjustments are made. It just helps you have a better understanding. And, we always do say, our fair market value is a notional, like our valuations are based on a notional basis. So, whereas price is quite different. So, you might not like the valuation, but that doesn't mean you can't ask a different price and go from there. But at the same time, it helps you, if you have, for example, what if you received an unsolicited offer, and it just gives you that basis to see if it's reasonable. Without the valuation, you might have thought, hey, I think I can get a bit more, but then you see, hey, this is actually quite a fair offer. Maybe we should look into, pursuing this. And it might help you, avoid the pitfall of maybe turning down something that did have a lot of potential.
Yeah, and like to your point, these companies probably don't turn over that often. So something might come up that you're not expecting, and maybe you're not ready to sell at that juncture, but maybe given the industry, et cetera, this might be your best kick at the can at it for a number of years. So if you're properly placed and kind of have some of that back end work done, maybe you go ahead and pull that trigger at that point in time. If it's always been, and I presume most business owners it should be, to eventually build that business to the point that you can sell it one way or the other. So if that opportunity maybe knocks at your door, then you're ready to go. So
no, exactly. And at the same time, it's one of those things when you've done this for a while. I've seen a lot of situations where there was a good offer on the table, and the individual wanted to, or the business owner wanted to see if there's, other offers or other opportunities. And so they turn it down and it disappears. And unfortunately, that was the only offer. And, what happens is they end up just closing their doors and liquidating inventory and selling assets, because that was, not to be too pessimistic, but, I think it's part of being realistic. The challenge of a small business is, especially if it's, under, $1 million in net income, is you don't have any venture capitalists wanting to purchase it because it's below their threshold. You need to find somebody, one, that's interested and can understand the business that you're operating, and they can learn it. But two, and this is often the bigger challenge, is finding a party that actually has the funds to make a transaction happen, and that can be a challenge.
For sure. No, that makes sense. So moving into question 4. So I guess we're kind of looking at, maybe in the general sense, how do I make the appropriate adjustments in valuing my operation? So let's say someone hasn't been doing the things that they should be doing to kind of keep things within the financials cleaned up and transparent. Maybe they or the accountant come to you and say, we need to get a valuation. Are there some specific things that this client should be doing to kind of help you out to, I guess, maximize what that valuation is going to translate into? Maybe certain expenses they should be looking at, one-time things, those type of things that they should be looking at?
No, exactly. So obviously, the easy one would be, wages at a different amount than fair market value. So, just in regards to that, can just be understanding what you would pay somebody. If you don't have any idea, we often look at, statistics around the type of role that is. And there's a lot of statistics with Statistics Canada and whatnot that, give you averages in terms of what people are paid for different roles. So we can use that. But in terms of expenses, it's just that having a good understanding of what is actually required for your business. So if you're able to provide a list, and because you understand the business better than, myself, obviously better than the accountant, although the accountant has a pretty good idea. But if you have a list, hey, this is all things that I run through that are personal in nature that, really aren't needed. Or then it makes it easy for us to then make those adjustments versus the other way where we have to kind of review the GLs and try and see what we think is discretionary and then go back to the owner and then ask them and go through that list. And it's like anything, you're going to miss items versus if the owner does that task and spends the time to really look and think about what isn't required. And then at the same time, it can also, like you said, relate to one-time items. Was there an unique repairs and maintenance expense that really never would happen? It just something happened out of the ordinary and you had to incur this big amount in 1 year. Well, that's something that you typically add back to cash flow in normalizing and figuring out what prospective cash flow looks like. And it's one-time expenses, and it's also one-time revenue pushes as well. I think an easy one, just to bring it up because everyone seems to have it these days, is during COVID, all the subsidies that businesses received, that's not going to be considered in the valuation. That's because that's a one-off, non-recurring, kind of unrelated item, although it was obviously very helpful and very needed during that time. But it's not something that you're going to include in your analysis of prospective cash flow.
Yeah, and I think that's a good point. I mean, I guess as an accountant looking at some of this information, from kind of that overview, you can easily look between the years to kind of see, maybe some trends, maybe pick up on some of those one-off items. But that's all presuming that, whoever's doing the bookkeeping for the client has, been consistent year to year, that maybe you even have the same bookkeeper over that 3 to 5 year stretch, and they're kind of fairly consistent with the way that they're posting things into the GL and stuff like that. So, yeah, I think we as an accountant office or as the valuator can kind of give the client a bit of guidance as to maybe which areas to look for and be able to kind of provide a bit of guidance as to what things that they might be looking for, because I find a lot of those things, some of those one-off ones for sure, because they're just that one-time thing. Maybe you had to renew the loan or something, and there was a loan application fee. Sometimes those are, $5,000-7,000, something like that. Just kind of making note of these types of things that you might not otherwise, pick up because they might just be buried in this big lump sum interest account. So having that client, be aware of what's going into those financials is helpful. And, I think it's helpful as a business owner to have a good understanding of what's in there on a regular basis too, not just once every decade that you decide to do evaluation. Having a good understanding of what your business is putting in and putting out, I think is going to help you long run too. So
No, that's exactly it. And yeah, I think the only other point, maybe this is related or not, I think sometimes people also make the mistake of focusing too much on top line revenue, and as that being their primary value driver. Like, hey, if revenue gets to X, I'm going to be worth this, and they focus on that at the expense of everything else. So,
right.
I've seen a lot of business owners get very focused. Well, I guess, yeah, focused on that item, and then expenses kind of get out of control, subcontracts get out of control, and bottom line net income obviously suffers, and cash flow suffers, and so don't just focus on one item thinking is what's going to drive value. As often, there's a lot more that can go into it, and just having an understanding that, uh, I guess the overall health of the business is often more important than one particular item.
Yeah, no, good point. I mean, it doesn't make much sense if you've got, say 5 million gross sales, but at the end of the day, net income's nil. I mean, yeah, sure, you're bringing in a lot, but maybe you're just as careless on the way out. And I think, like you said, people are basing their expectations of the value and wanting to purchase your business based on the cash flows, not just the revenues that you can generate. And, you know, some of those expenses and maybe just the overall operations of the business, maybe those are tied to you or they're tied to a particular structure that you have in there. And maybe some of those things can be tweaked, but I think it becomes a very difficult, discussion to have to say, well, yeah, I've run it for the past 5 years. We're doing great on the growth side of things, but every year we're netting out to next to nil. But if you just did these three things, it would fix everything up and it would be a cash cow and you would be laughing. I mean, I don't know. I don't know how convincing of an argument that's going to be. I think you've got to have a proven track record there to support your claims on the business. So
No, and no, that's exactly, and that brings up another thing that we often see is that exact conversation where it's like, hey, if you do those three things, cash flow is going to be this, and it's going to be worth X, and it's like, I think you need to understand that if a potential buyer does those three things, then well, that's value attributable to them. That's not value attributable to you, and so they're not
exactly.
going to pay you for a maybe that might occur if they make all these adjustments. And so that's something to keep in mind in terms of value, is that you need to show them what the business can do today,
Yeah.
and what's realistic, not hey, if this owner is really savvy and they do all these things, it'll be worth
Mhm.
this, and therefore they should pay me based on that.
Yeah, because if those were the three things that you needed to take this business exponentially to the next step, why isn't the current owner doing that? And why would I be paying for something that may or may not happen down the future? So
Oh,
good point. Good point. So the next one, I know we've kind of talked about maybe adjusting or adding back certain expenses that are, one-offs, etc. Are there any additional costs that a potential buyer could expect in the future that aren't maybe reflected in my financials? Like, I guess where I'm going with this, and we kind of touched on it when we're looking at the wage component, that owner's in there, maybe he's taking 100K a year. This potential buyer is looking to take this, investment on. Maybe he doesn't want to be involved, or maybe he has someone in mind that could run the operations. But are there certain things like that? They're more of an intangible that you can't really account for. If that owner's experience disappears, does this whole operation just crumble? Or is there kind of a way to maybe look through some of the numbers into more of the deep-seated, structural components of that business to say, yeah, if we take this guy out, even if we get 50% out of whoever's replacing them, we're still going to be okay by buying this business.
No, yeah, you basically touched on, I think, the main component, which is, a business owner's kind of personal goodwill versus commercial goodwill. So like
Right.
when you buy a business, there's always that risk that a lot of the value you're paying for is attributable to the owner,
Right.
or to the previous owner. And so, you know, will that value disappear when they disappear? Will customers suddenly use their exit as maybe an opportunity to start, having discussions with competitors where they might not otherwise have because they just enjoyed working with that individual? Will their departure cause uncertainty and similarly cause customers start looking elsewhere? And so that's the challenge, is really thinking about that personal versus commercial goodwill component, how much of goodwill just relates to the name of the business and the trust it has in the marketplace. And so I think when you're doing that analysis, I think part of that would be, is the current owner very involved in everything? Do they,
Right.
are they the ones that interact with all the customers, whereas their employees are kind of just in the back doing the work, and customers really only ever see that owner's face? Um, you know, Things like that might indicate a lot of value could be attributable to the owner. And then, ways to mitigate that. I mean, I think the simplest way is obviously making sure that that existing owner, there's a bit of a transition period that's appropriate, based on what the business is, whether that's, 6 months, a year, 2 years, to help, smooth um, those relationships over to the new owner.
Gotcha. So I know you've mentioned it's always a difficult task to kind of sell those private companies. Does it become that much more difficult when a good chunk of the value of the business is kind of attributed to, say, that personal goodwill component of that business owner?
Well, I think the I think maybe other question to that is, um, will you pay for that value attributed to that owner? So
Right.
if if you're concerned that a large portion of value relates to that owner's relationships, personal goodwill is not transferable.
Right.
You can't, if that person leaves, that goodwill is gone. It
For sure.
all relates to that individual. And so, that's going to have a negative impact on value. And I think it goes back to our previous kind of comment about trying to run your business in an arm's length manner as much as you can, because again, that's another thing. you know if you're doing the best you can to manage it, in terms of, if you had to find some way to replace your role, in terms of making sure other employees are involved, and it's structured like like in a large organization, it has
Right.
policies in place and it's got systems in place. It eliminates some of that personal goodwill of risk, and makes the goodwill more commercial,
Right.
more transferable to a potential purchaser.
Perfect. No, I think that's a real good point because I think a lot of small business owners get into that particular little niche where they are the business. They're dealing with clients, they're dealing with suppliers, you know, whatever advertising goes out, it probably has their name and their face on it. And if it wasn't for them, that business doesn't really exist in the scope of being a sellable asset to someone else. So, yeah, I think it's probably important to take those steps early to maybe start transitioning some of the responsibilities that you have as a business owner, over to some employees, or, whether you maybe diversify out and get some contractors or whatever the case is that works good for your operation. But just to move some of that stuff a little bit downhill, take yourself out of it a bit, and kind of slowly move. I think there's this natural path that small businesses go on. When you start them up, you're kind of typically that employee. You are the business. If it wasn't for you, no work would get done. And that's kind of that first stage. Then you get into that second stage where, you're more of a business owner. You might have a few employees, but still, without you being involved, the business is going to have a hard time keeping on. I think you need to then kind of move out of that particular business owner role and more into that investor role. And you then are just overseeing the business as a whole, and you've got some senior staff and then some junior staff that kind of work within those policies and procedures. And if you were to step out, the work continues onwards and it doesn't just immediately shut down. I think at that point in time, then that business becomes a bit more of a sellable asset.
No, that's a really good point, and I think it's a challenge. I mean, we all face it. It's you build a business, it's your baby, and it's hard to put trust in your employees, maybe to do some of those things to make sure that they're going to do a good job and not make a mistake. But at the same time, it's kind of needed to maximize value of your business and to make it as saleable as possible. And it's also important just in terms of employee retention. You always want to be building up your staff, making sure that they see a future by staying with you, because I've seen it before where as soon as the business owner announces that they're thinking of selling, suddenly staff start exiting, and they're worried that there isn't a place for them anymore, or maybe things for whatever reason didn't turn out the way they thought, and that brings a whole nother issue. Whereas just as you're about to sell, just as people are starting to look, they're seeing all this uncertainty. Staff turnover is huge.
Right.
How's that going to affect a potential buyer?
Yeah, so again, that kind of harps back onto that point when you're looking to maybe do some transition planning, that you have those key employees or family members or whatever the case is in on those early discussions, well ahead of time before you even considering selling, just to let them know that at some point in time, this is the plan for me to move beyond this. So I want to take the steps to to obviously preserve my legacy and protect the business, but to also put you, as employees or, kids in a position to succeed as well, because, it takes that whole team to kind of ensure that the business continues onward. So good point.
Exactly.
Next one. What do my financial statements show about the value of my business? So what I think I'm trying to pull out of this one is, let's say, for instance, you get that unsolicited offer. Someone is just approaching you, you've got some financials, but you haven't really gone into any in-depth valuation work at that juncture. Like, I know for accounting firms, typically when they get bought and sold, it's just kind of one times, billables. That just seems to be the golden rule in accounting practices. Is there something else that, maybe a business owner can do when maybe an offer comes up, that they could, have a quick look at their financials and say, maybe this offer is worth looking into, then I should, reach out to that valuator maybe to pursue things a little bit further?
Yeah. So, I mean, you bring up two good points. The first being, some industries, just due to their nature, do have very established rules of thumb. Like you mentioned with accounting, I mean, you see it lots. Dentistry has a similar type of thing. Insurance writers, have a similar thing where there's industry norms in terms of what they transact at. And so in some cases, it's very straightforward in that you just look at top line revenue. There's this accepted kind of multiple, and that tends to be where it lands. When you're looking at a set of financials, in terms of analyzing value, I think there's a couple of things. So there's, one, you could just be looking at, your historical revenue. Is it pretty consistent from year to year? With just, a little bit of growth that, something like that, shows, one, there's minimal volatility in your business. That adds a lot of just positive value in that, a business owner knows, hey, this business isn't subject to a lot of economic downturns or changes within the industry. It's just slow and steady. So that's going to increase value. You're going to obviously look at, how many assets, what's the value of your assets on your balance sheet, um, you know, it's not just net book value, be honest in terms of what those assets are worth. And so, another valuation tenet is, the greater the net tangible asset value, the greater the fair market value of the business. And that just obviously makes sense. You're not going to sell your business for less than what you liquidate your assets for. And at the same time that, if you're, a retail business or a service company where, there really aren't any assets, there's some leaseholds, you don't own the building, some furniture is not really worth anything, there's some computer, keep that in mind too, that, that obviously increases risk because, if somebody buys your business and it doesn't work out, they're not going to receive anything back on their investment versus, you buy a large construction company
Right.
and for whatever reason it doesn't work out, you can liquidate all the yellow metal and recuperate 60-70% of your investment, and so your downside risk is a lot less.
Right.
So those are some high level things. The other thing, obviously, bottom line net income is important, and as the owner you're going to know whether there's a lot of, like we mentioned, discretionary items on your balance sheet. So if somebody's offering you 300,000 and your bottom line net income is 150,000 and it's a legitimate 150,000, there's not much discretionary there, that might tell you things are a bit low in terms of the value that your business has, and it might raise some red flags that maybe this offer is not as good as it could be, or maybe I need to do some more analysis to maybe understand why they bid that way, just to whether or not you accept it, just to understand your business better. And then if there is a cash flow statement attached to your business, that's obviously important. Understanding where cash is going, how much excess cash your business is generating. That's key. I mean, people often say the cash flow statement is the most important part of the income of the financial statements. So where there is a cash flow statement, it's good to just understand how much cash your business is generating, whether that cash is, just being added to your cash balance and growing, or whether it all has to be reinvested back into the business to sustain it and or to service debt, or whatever it might be. Yeah, all those things kind of, and unfortunately there isn't like an easy look at this, but I think the sum of those parts, look at volatility with revenue, the value of your assets, bottom line net income, has it historically been pretty consistent, similar to revenue, or is it vary quite a bit, and cash flow, and the sum of those parts ultimately drive value.
Well, that's a good point. I think it's good for, small business owners just to kind of keep some of those tips in the back of your mind there as to kind of things you can look for from the financials, at a reasonably quick glance, and you can kind of then determine, is this offer worth pursuing? Should I bring it into the account, or, are we not even getting off to a decent negotiating place here? Because, at the end of the day, both parties need to find a price that's going to work for the both of you. So, you don't want to waste excessive amounts of time with offers that, aren't even hitting into the ballpark. So I think those are good places to start for sure. So just kind of in the interest of time, just want to wrap it up with one more question. So do you have any tips for small business owners who are thinking about selling their business? I know we've kind of talked about a number of things over the course of this episode and even back to that first one, but anything else that, kind of comes to mind?
Well, I think just what we talked about, be honest and realistic with yourself in terms of what your business is worth. Obviously, I'm biased. I think having a business valuation sooner rather than kind of later helps, because it just gives you that baseline. So from there you can assess a couple of things. One, you got the it's not just selling your business; it's also emotionally preparing yourself for that exit. You got the are you financially ready to retire? And so, seeing roughly what your business is going to generate you when you sell is going to help with that analysis. And then, and also starts to put you in the mindset of, what are you going to do after you get rid of your business? I think a big challenge for business owners is, they've spent so long building their business and it's such a part of themselves, is just figuring out what to do on that next stage. And just
Right.
don't it's like anything, don't just look at the numbers. There's also kind of an emotional and a personal aspect that should be considered when you're making that decision to bend your business.
For sure. No, I think that's a good point. I mean, at the end of the day, valuing or selling that business or whatever ends up happening, yeah, there's a lot that goes in on, the financial side of it, the legal side of it. But in all reality, those items are fairly simple. You know, you get the figures, you get the valuation put together, you talk to the accountant, you figure out a structure for the deal that works for, tax purposes. You talk to the lawyer to make sure the deal is structured as far as, the legal items correctly. All of those things kind of fall into place. I think that biggest item is like what you say is just kind of that personal attachment and being able to kind of see yourself moving past that. And maybe it's not necessarily a clean break from the company. Maybe you're giving up control over a period of time to family or to employees or something like that. But yeah, if you have those discussions early on, then everybody's on the same page. And I think then that transition plan becomes that much more likely to succeed, as opposed to something that is just last minute rushed and sometimes maybe even forced into existence based on, a life event that creeps up that you're not expecting to happen. And then, at that juncture, maybe you do get the dollars out of the business that, you were reasonably expecting, but then maybe that employee or that family member isn't correctly prepared to take on that role, and then the business ends up failing. And I think for business owners, I think the big thing is that emotional attachment and seeing that business kind of carry on and be successful, not just necessarily pocketing the best tax, after tax dollars. So good point there for sure.
No, exactly. And, like, I guess we're both biased, but and it also brings up an important part to having a strong, network of advisors. It's, a lot of businesses might not have a CPA firm, doing their year ends. Maybe they have, a bookkeeper, which again, there's nothing wrong with that, but they might not have the experience in terms of understanding the tax implications with certain things. And so it's one of those things you might find out after the fact that there might have been a more efficient way to do this that, would have saved you, well, in terms of using your capital gains exemptions, hundreds of thousands of dollars. And so it's also just important to make sure you have advisors that you trust and advisors that are going to make sure that you're in a good place too. So, sometimes that's not valued as much as it, as it should be.
For sure. No, good point. So I think that's it, Justin. I just want to say thanks again for taking some time out of your busy schedule to hop on the podcast with me again. I know you provided a lot of great value on the intricacies of, how to get to that valuation, the things to look for, how to prepare that business owner to reach that maximum value. If listeners want to reach out, touch base with you, what's the best way for them to get a hold of you?
So, you can always find us on our website, which is just joneslam.ca. My email is, justin@joneslam.ca. And, I always say, never be scared to call. My number is 780-554-4323. And, we're just happy to, have a discussion and answer questions.
Perfect. I will put all that information in the show notes. If you want to touch base with Justin, feel free to reach out to him with any valuation questions and issues down the road. I know he would be happy to chat with you. For the Tax Talk podcast, I'm Jared Pallon. Thanks for listening. Take care, and we will talk soon.